Hello, everybody, and welcome back to What the Hut. And I am Tabs Wadey, and I am an award-winning, big-hearted, community-minded property investor from sunny Worthing here on the South Coast. And I work with investors just like you to earn them great returns on their hard-earned savings. Today, we're still at the seaside, I promise you, but we're just along the coast a bit to Brighton and Hove to chat with Adam Coffin from Coapt. Now, if you've ever tried to rent or to buy or even to park in Brighton, you'll know that it's this gorgeously bohemian world all of its own. Now, Coapt are one of the city's leading property agents, specialising in student and professional accommodation. So Adam's got his finger very firmly on the pulse of what's really happening in the property market. We're going to dive into the Renters Reform Bill, how it's reshaping landlord strategy, what's happening with HMOs and student lets, and what Adam's expecting from the budget. You've got your crystal ball ready. So if you've got property interests or ambitions in coastal or student-heavy markets, you'll want to stick around to hear Adam talk. Now, here's the man himself. Hello, Adam. How the devil are you?
I'm very well. How are you?
I'm good, thanks. I'm good. Now, for anyone who doesn't know Coapt or you, can you give us your quick elevator pitch, who you are, what you do, and what makes Brighton such a unique property market to work in?
Yeah, great question. So Coapt, as you quite nicely said, are a student specialist agency. We let and manage a grand total of 500 HMOs, which keeps us nice and busy. That's about 2,500 students to look after every year. And anyone who's in the student market knows it's good fun, is the way I'm going to phrase it. We do everything from property management to lettings, and my remit in particular is property sales. The way I very much position myself is a property nerd, a bit like you, Tabs. We love the devil, all the details and the devil of it all. And the way I've sort of succeeded in my career with Coapt is very much by giving advice to clients and to landlords. If that results in a sale, then that's obviously what pays my bill. But ultimately, we just love talking to clients and giving them advice about this crazy industry we all choose to work in for some reason.
So, Adam, Coapt's been a big player in the market for years. Can you give me a quick snapshot? What's the business focus, and how have you seen the market evolve in recent years?
Yeah, absolutely. So, we've been in the student market for 21 years now. 21 years strong as well, and that's 21 years of growth as well, which I know we're very proud of. The market's changed a lot. I think anyone who's also operates in the student market will know expectations have changed on the tenant side in particular. But lots of the benefits do remain the same. I mean, the student market's fantastic in that it's cyclical. Year-long tenancies generally is the standard, which obviously gives you a yearly opportunity to review your rents, to review your property and the condition, and also just the chance to have guarantees and assurances on your income. There's a lot less uncertainty, I think, than professional buy-to-lets and standard buy-to-lets with HMOs, and compared to professional HMOs as well, where you tend to have working professionals who might come and go throughout the year. Students, you know when your window is every year when that tenancy is going to change. And expectations have changed a lot, I think, for the better, and I think it's a good thing for the industry. Tenants expect more, and I think rightly so. Rents have risen dramatically, certainly the 21 years we've been going, but year on year as well. And I think it's understandable that those tenants expect more for their money, which is completely fair.
So Brighton, I think you'll agree, is a bit of a micro economy.
Yeah.
What's the investor sentiment right now? Are landlords, are they holding? Are they selling? Or are they cautiously buying again?
Yes, I think a good place to start is why people would always invest in Brighton in the first place. Because you said it is a bit of a microclimate. Property prices, so the capital values of properties are quite high. We're London by the sea, as we're commonly known. Not quite the same prices, but not far off at all. Rental figures are then also very healthy, but then you do tend to find that gross yields in Brighton are not as good as they could be in other parts of the country. So therefore, people investing in Brighton, we tend to get people investing for capital appreciation, for security of investment. We've got a lot of lovely Regency buildings, particularly around on the seafront. Good property to own and hold because it's not going to go down in value. It's a good asset. Cash flow, if you invest in the right places, is still fantastic. So you can definitely be at both ends of that scale for capital investment and capital appreciation and cash flow. The sentiment has shifted. I think this will be the same countrywide, but obviously with our particular market in Brighton, we have noticed a nervousness amongst investors.
Yeah.
I think that's understandable. There's the rights bill, which I'm sure we're going to chew through in a moment. The changes to EPCs on the horizon, interest rates. If you've had a renewal of your mortgage any time since 2022, that's probably tripled, if not quadrupled, your running costs. So landlords are nervous, but there's also opportunities, and that's always the flip side of the coin. We work with a lot of buyers at the moment who are seeing uncertainty, and others leave the market as an opportunity for them to purchase at a good price. And
Yeah.
that's the angle we definitely spin when we're speaking to buyers, for sure.
Can I ask then, from your perspective, are yields and capital growth prospects still attractive enough to justify the regulatory headwinds?
Yeah, there's definitely been a shift. In Brighton and
Mm.
Hove for HMOs, the golden standard was most investors we worked with were pretty chuffed if they could get between a 6 to 7% gross.
Right.
For years, that was sort of the going rate. Obviously, both the capital value and the rental raw values changed, but a 6 to 7% gross was pretty standard. And now that's
Mm.
shifted quite dramatically. So now it's got to start with at least an 8% plus, and even up to sort of 9% yields. So quite a big step up percentage wise, because you want that higher return to balance that risk, as you said. And obviously, we are talking about gross yield there as well. So although actually the 8 to 9% is a big step up, you'll be losing a
Yeah.
big chunk of that in your increased costs as well.
Yeah.
Why that translates.
So can we talk about the dreaded renters reform bill? It's not dreaded. It's good. It's good. Section 21 is being scrapped now here on the 1st of May.
Yep.
From an investor's point of view, what would you say are the key takeaways regarding the renters reform bill?
So starting with Section 21s in particular, I think any landlord who's ever served one will know the sort of the labelling of a no-fault eviction is a mass oversimplification. There's always a reason you serve a Section 21. And in most cases, the vast majority, in fact, the reasons you would serve a Section 21 would most likely be qualifying grounds for a Section 8. It will be a problem tenant, missed rent, damages, or because you're selling or changing your investment structure, all of which are currently grounds for a Section 8. The reason you traditionally use a Section 21 is because it's quicker. It doesn't go through the court. It gets a much cleaner cut. Arguably, it's better for the tenant as well. If it is a problem tenant, and I don't use that word lightly either, most tenants are fantastic. We all know that. But there are a few bad apples out there, just as there are bad landlords. But if you do go the Section 21 route for a tenant who's not paying rent, for instance, in theory, that tenant can move on scot-free, and actually they don't get any downsides either. So any landlords worry about the scrapping of Section 21s, the reassurance I would give you is any reason you would want to repossess a property, you'll still be able to. So if there are rental arrears, if you're selling, if you're moving in yourself, you can still repossess, but it will have to be through a Section 8. And I think the biggest downside will be the timescales. Currently, a Section 21 is a lot quicker. Section 8 will have to go in front of a judge or through the court process. There needs to be a determination that Section 8 is fair or has a reason, hence the scrapping of no fault. You have to evidence that reason now. And I think that in itself will take longer, but coupled with the fact that everyone will need to go that route, I can imagine the courts are going to get very busy very quickly.
Are you seeing any panic? Are landlord clients, how are they responding? Are any of them like restructuring their portfolios? Are they adjusting rents, or are they simply waiting it out?
There's definitely lots going on. People planning ahead, especially now we know the implementation date. As you say, May the 1st is when phase 1 comes in, which is sort of the main headline parts. There are later points for other parts of the bill arriving, but the banning of Section 21s and ending of fixed term tenancies is all from the 1st of May. And people are sort of getting their ducks in a line before then, for sure. An iron of the bill, which we forecasted a long time ago, is every data point you look to says there's actually been record numbers of Section 21s since it's been announced that they'll be scrapping a Section 21, which is rather ironic. I think that makes sense. Landlords who maybe are slightly unsure about their tenant, maybe they've not, they're constantly late on payments, but not significant enough to warrant repossessing, or they're doing work in the property, or they're a bit uncertain at the moment. Lots of people were issuing Section 21s whilst they still can, in effect, which is quite an interesting takeaway. And for us in particular, I mean, we've noticed a big shift towards the student market, which is really interesting.
Wow.
All the reasons I mentioned earlier, the student market is very cyclical. Largely, the tenants want the property for a year, and very rarely do they want it longer. Very rarely do they want it any less than that. And so you do have a bit more certainty with professional tenancies or family lets. Once they've moved in, as I said, unless they do something to warrant a Section 8 or you're selling or want to repossess for one of those guaranteed reasons, those tenants will now call the shots on how long that tenancy is in effect. But with students, again, you do have that expectation or a much higher expectation that they will leave once a year. And actually, you can still repossess a student property, which is quite a niche part of the bill under grounds 4A. So in effect, a student property, there's a few terms to that. So it must be all full-time students and it must be a HMO, but you can still repossess that property once a year if you issue a ground 4A when you issue the tenancy agreement. So you've got a firm end still.
That's top knowledge. Thank you. Thank you for saying
that. No, it's good to know. Yes.
So do you think, and we hope, that the bill can accelerate professionalism within this sector, with fewer casual landlords, more business-minded investors?
That's certainly the shift I'm seeing. We are selling more properties, investment properties, and more HMOs than we used to. It's not an exodus like some people would have you believe, but more landlords are taking stock and reviewing, and there is more properties in the market than there traditionally has been. And then you're right, yeah, the landlords who are selling tend to be what we would consider accidental landlords. So maybe single properties that have been inherited, they're in an unfortunate position of not needing to sell, so have given the rental market a go for a bit. Or just general smaller scale landlords, so maybe 1 to 3 properties, particularly if you're highly leveraged, because obviously there's a lot more risk there as well. Those are the kind of sellers we're seeing. And on the flip side, the buyers we're seeing are, generally speaking, larger institutional buyers now. Hedge funds, overseas internationals, a lot of cash buyers, and you're right, there's sort of definitely a migration towards fewer landlords but with larger portfolios and more argue, yes.
So what part of the bill do you think will hit the student and HMO markets hardest?
Yes, so as I said, the student market's quite fortunate in still having that option to repossess, which in the student market is really, really important, because for most buy-to-lets now, you won't know when your tenant's going to leave until they give you that notice. Now, anyone who operates in the student market, especially in Brighton, know that. So it's now November, we're already advertising our student HMOs ready for September 2026 move-ins.
I've got my lovely students ready.
Nicer properties as well, your lovely house, yes, absolutely.
Oh, thank you. Thank you.
And the student market doesn't work unless it's set up and works because we can advertise so far in advance. We can still do that, fortunately, because we know we have a firm end. We can still repossess that property using grounds 4A. We know we can still advertise that property for a set date and not have the risk of the tenant staying on longer and then it not being vacant ready for the next group. The downside, and this is the same for any type of tenancy, is whereas with fixed terms, you had a certainty of a guaranteed income for a set period. Now those tenants can serve notice to leave with 2 months at any stage throughout the year. And that is actually arguably one downside to student tenancies now, particularly HMOs. If your student tenants leave midway through the academic year, the opportunity to relet that property in, say, February is a lot harder than a traditional buy-to-let, because the student don't tend to move at that time of year. And so that's the risk for student landlords. I think the rewards are larger and the securities we've got in this market is better than other buy-to-lets. With the added side of things that not many students do look to leave midway through the year. Most tech tenants want it for the full academic cycle. There's occasional fallings out or people drop out of their courses, but most will want it for the full year. The real kicker, and the thing we've been sort of mulling over for quite a while, is that of most exams finishing in around early sort of June, July time. Currently, most of our fixed-term students run from September to September, and there is the expectation that actually a lot of tenants will look to leave once their exams finished in early June, July. And so there's the question mark at the moment about summer voids. But that's the kind of the challenges we're looking at the moment, is just making sure tenants or landlords have that still year-round occupancy, which is what makes the student market work.
Yeah, because landlords will need to look at opportunities within those summer periods. if that's the case, won't it?
Yes, so I don't mind giving you a bit of insight of what we're doing to sort of, I'm not going to say get
Oh,
around that because that sounds a bit sneaky, but the fix we found for our clients, we actually spoke with a lot of over local agents. So as I said, Coapt let and manage about 15% of all the HMOs in the city, which is quite a big chunk. And we managed to sit down, put our pitchforks aside, and spoke to a few of the other big student operators as well. None
great.
as big as good as us, but we did invite a few of them for a bit of a chat, and we all
Nice.
came to the same conclusion, which is the student cycle in Brighton, and I would suspect this will be the same in lots of parts of the city, is going to move sooner. The idea being that if you offer your property to let moving forwards to move in June, July time, and with the bulk of the market doing the same, which is what most people come to the same conclusion of, you'll still end up with a year-long tenancy.
Great.
So you move your tenants in earlier, and they'll start and have the summer up front before the academic year. The only reason that model works is if the whole market does that in cohesion. So the students have the option of moving in June, July, or potentially missing out on housing. They won't have a lot of choice. That sounds a bit horrible and sort of leveraged, but that's the solution that landlords need to seek ultimately. And then you still have a 12-month tenancy on the assumption they'll leave in the following June, July.
Perfect. Um, so HMOs have long been the sort of go-to in Brighton.
Yes.
High demand, solid yields, but are they still stacking up under the current licensing and energy efficiency rules that are in place?
Yeah, it's a really good question. I mean, I would one thing I would always say from the get go, and I think most landlords and most listeners today will agree with this, is licensing in the right way and policed in the right way is the right thing. Landlords should be held accountable for good quality housing. That's vital. I think it really is. Um, I do have a lot of question marks with some of the ways some of the schemes are run. I was at an event yesterday, and a few landlords, it's not my own words, but a few commented that licensing can be seen as a tax for good landlords. I think it's quite an interesting perspective and not entirely unfair either, I don't think. But Brighton and Hove, we are quite heavily licensed. So just as the rest of the country, there is national or mandatory HMO licensing. We do also then have an additional scheme, so that covers 3 and 4 bedroom properties, which isn't in all parts of the country. And now we also have selective licensing being rolled out, which will soon be citywide. And ultimately, the expectation is within the next 2 to 3 years, every single rental property in the city or privately rented property will hold some form of license, be it a national, an additional, or a selective license. As I said, the licensing and meeting those conditions itself, I think, is a good thing to a degree.
Yeah.
And dare I say it, the licensing, yes, it's a pain to pay a few £100, but it's not going to break the bank, especially when you consider the healthy returns from HMOs, as you say, because the cash flow, that's why we do HMOs, right? Because
Yeah.
rental from 6 sharers versus a single family is significantly higher. And that's what makes them viable. So there's a very long way of answering your question, but yes, I think they do. And that's why HMOs have always been such a desirable option, is the high cash flow. You know what you're getting yourself into generally, which is more work, more licensing requirements, certainly more wear and tear and maintenance needs, particularly with student tenants. But the flip side is the financial reward, which is the rental returns being significantly higher than an equivalent residential let.
Yeah. Yeah. So for investors wanting to come into the market now, Adam, what sort of returns are they realistically going to be seeing on a fully compliant HMO?
Yeah, absolutely. And I think this obviously depends entirely on where you're investing and what your investment strategy is. I mentioned the sliding scale earlier, and it's still the first question I ask any buyer is, where do you sit on that scale? And I think it's a good question for any investor to ask themselves. Why are you investing and what are you looking to get out of that? Are you preferring cash flow? You want it as a second income or even a primary income, and you want high levels of rental income versus capital appreciation, which it's not a mutually exclusive thing. You can sit anywhere on that spectrum, but capital appreciation being, you want to put your money somewhere safe in a property, which, for the long term, which will hopefully go up in value. As long as the rental's paying off the expenses, you won't be, you're not chomping at the bit to make loads of extra money. You're just putting that money somewhere safe in something tangible. Property, which is, I'm very old school in that approach. I like property because you can see it and touch it. I'm not much of a stocks and shares man. I like bricks and mortar.
Me too. Me too.
Yes, absolutely. But it's good to know where you sit on that spectrum, and that makes a big difference then to what you're going to buy. And again, the level of risk you're willing to take on as well. But yeah, as I said earlier, there's sort of a good yield to aim for a mid-spec HMO in Brighton and Hove currently. You want it between that 8 to 9% gross. That's just if anyone doesn't know, to break down that equation, that's your
Yeah.
annual rental versus your purchase price.
That's really helpful for people to know.
Yeah,
Do you know what I
just
mean?
we always assume people know, but they don't always. And again, you'd be saying an 8% return, so that's the lower end. So your rental isn't as good versus the purchase price. You'd be pretty happy with that if it was a really secure investment. So something in a really high demand rental area, maybe it's going to be pretty low maintenance. It's in good spec, low running costs. Maybe a slightly smaller property. You'd be satisfied with maybe an 8% yield, which is on the lower end of that scale. The cash flow is not good, but your risk is a lot lower. Whereas if you're buying slightly further afield or a larger property or something not quite as modern, or that's going to need more investment over time, something more towards a 9% is pretty healthy. So you've got more reward for the increased work in effect.
Student demand in Brighton has always been consistently strong.
Mm.
Are we seeing that continue post-pandemic,
Yeah.
or are patterns shifting?
Yes. So post-pandemic, the rental market held pretty strong. But these last 12 months have been interesting, is the word I'm going to use in the student rental market. It's been a slow year by student market standards. And I say by student market standards because, it is a very small minority of properties HMOs struggle to let this year. But it is a very small minority. But as you said, the student market has always been so exceptionally strong. There's two very large universities, as well as several colleges for which students of university age also go to and need shared housing. There's always been massive demand and undersupply. This last year, a lot has changed, though, and that supply-demand balance for the private market is a lot closer than it used to be.
Do you think that there's anything to do with those, that there's been lots of blocks going up, particularly on Lewis Road, purpose-built student accommodation? Do you think that has anything to do with it?
Yeah, there's a culmination of reasons. It's never super simplistic, but the purpose-built blocks, PBSA, is certainly a big part of that. Those blocks have been going up for some time, actually, so their impact has been gradual. But the biggest change this year has been as I go into in a minute, the market's been smaller as a whole, and those blocks traditionally target first-year students only. They're set up perfectly. The little studio unit's perfect for first years who don't have a group of friends just yet. Now it's the first year market which has really struggled. Yeah, very cute.
Yeah, it's good.
It's the first year market in particular which has been slower this year. So those purpose-built blocks themselves have struggled, and they've now changed their own approach to accept second and third year students, which traditionally is the main demographic for private HMOs. So yes, traditionally PBSA, we didn't mind them because they were fishing in a different pond, and actually more housing for first years just means potentially more first years who become potential tenants in second and third year.
Yeah.
But then now it's becoming a bit of a Venn diagram that's crossing over a bit more. And I mentioned that first year market being smaller. There's multiple reasons for that. And it's amazing, some of them. We're a bit, as I said earlier, we're a bit nerdy. We like delving into the details. It's a bit boring, really, but we do find it fun. There was a low birth rate 18 years ago this year, so that particular cohort was always naturally going to be smaller. Even if the same percentage of 17 to 19-year-olds went to university, there's less people of that age in that age group at the moment, which sounds really niche, but it makes a difference. There's also been a lot less international students in the last couple of years, and that's quite significant. And that does stem from, yes, COVID, also Brexit, and also just general economic uncertainty as well. If you're a young person looking to move to the UK, you maybe saw it as an opportunity to come and get a great education, but also stay here and find a good job. Maybe there's less assurances of that now. And so you're looking at other options, particularly in the European Union instead, rather than the UK. So yeah, lots of reasons, lots of nuances, but the student market has been slower this year. Not cataclysmically so. I'll get there in a minute. Not cataclysmically. And the story still holds up that if you've got a good property and you look after it well and you're asking a reasonable rent or a competitive rent, you shouldn't have any concerns about getting that let agreed.
Great. Can I ask you then, what is the kind of current balance between supply and demand for accommodation at the moment?
Yeah, it's a very good question. So it's quite a good time of year to ask that question, actually, because obviously the new academic year has we're just about started now, September. We've been going for a couple of months. There was less than 2% of HMOs on the market for this academic year that's just started that haven't been let agreed to students. Less than 2%. And if you look at that number, there's almost always a reason why. That's pretty obvious. It's properties which are further afield, of a lower spec, or a combination of things, and asking too much with those other two things in mind. Or dare I say, is not using a specialist agent who's in the right market. That's a bit of a slight plug there for me, if you won't mind me doing so.
No, not at all.
And it is a small minority. And obviously there are options. That's not now 2% of HMOs in the city which are suddenly just sat there empty. Those landlords, and we can help landlords with this as well, can turn to other markets, professional sharers, changing use potentially back to a family let. You have to be careful with that to keep your planning status. As well. But yeah, it is only a small number that struggled this year. And as with any market, when demand decreases, supply will drop as well. So again, my particular role at Coapt is sales, and we're selling quite a few vacant HMOs presently. If they were unlet, if you're not quite as keen on other types of rental which don't have the same cash flow, now it's time to perhaps bank on your capital appreciation and sell that asset. And if that HMO sells residential, the pot gets smaller, so that supply decreases back in line with.
Very interesting. If you had £500,000 spare, Adam, and you didn't want to invest it with me, can you tell me where in Brighton you'd be putting it? And would it be for yield or growth, or a bit of both?
Yeah, really good question. I think one thing I'd start off by saying is I always used to be of the mindset of leveraging yourself to the eyeballs, stretching that money as far as possible. I would always prefer to put down minimal deposits and take out maximum loans, buy multiple properties with that money. Very much of the opinion of I'm on that capital appreciation side of the scale, let multiple assets grow in value rather than a single property. I've now probably changed my tune a little bit on that, and that's not in no small part due to interest rates being where they are, and some of the risks we've spoken about. I think now there is certainly an argument, and I'm leaning towards the other side of lowering your risk levels. And with that in mind as well, my investment would be with that same mindset. I'd be looking for key rental areas. It's the classic, this is rule 101 of investing, right? Buying a good area with high demand. Buying those central areas. So for student housing in Brighton and Hove, if you draw a line between the Palace Pier and Falmouth, Sussex University, where you want to be is smack bang in the middle, which is fun enough where our office is on Lewis Road, and where you've got a lovely investment property as well. I'd probably buy right on that corridor there, and a smaller property, a 4-bedroom HMO.
Okay.
The reason I do is you have got the option then develop it. There's always a fantastic thing about property investing is the option to add value. Everybody knows there's a lot of money to be made in loft conversions, rear extensions, refinancing to take out your gain, go again. Also though, because those 4 bedrooms are in quite high demand for the rental market, that's where the supply demand balance is certainly still in the favour of the landlord. And also because you've got more flexibility with a smaller property, right? With a 3 or 4 bedroom property resale, you've got the option to go back residential. You do have residential letting options as well to families or sharers. Larger HMOs, they've got fantastic cash flow, but you've got to be prepared to be very narrow-minded on that HMO market. 6, 7, 8 bedroom student properties will have phenomenal cash flow. But you're very much banking on that market remaining strong because your relet or resale options aren't quite as strong.
Yeah, and I think landlords need to be realistic about, even when they have fantastic management, they have to be realistic about the type of things that can go wrong and the level of work or the cost involved with making sure everything's running properly.
Yeah, absolutely. Same as any good property investor will have a war chest for a rainy day, be that repair work or a couple of months worth of void if needed to cover mortgage payments. Again, it's sort of investing 101, really, isn't it? Sort of prepare for the worst, hope it doesn't happen.
Yeah. Outside of your fantastic corridor, Are there any other emerging neighbourhoods in sort of Brighton or coming along Portslade, Lancing, Worthing,
Yeah.
even Bognor and Littlehampton? Is there anywhere else that sort of catches your eye that's
Yeah.
worth? Yeah,
Yeah, certainly westward of Brighton. So out towards your direction, Tabs, for sure. Out in sort of all the places you mentioned, yeah, Worthing, Shoreham, Portslade, all these places. Not so much for the HMO market, because the demand isn't as strong. There is still a market for HMOs, but you're more looking towards professional sharers than the student market, purely because of the situation, the distance to universities. Um, but capital appreciation and property and sort of raw property investment, those areas are increasing in value, and certainly stand to keep increasing in value much quicker than other parts of Brighton in particular. Um, Again, this is quite an old school approach to investing. If you look at a major city, people tend to flock to those major cities. Brighton is very saturated. And so those areas in the peripheral, grow and increase. Eventually, Brighton will in effect incorporate those wider areas in terms of the pricing levels. And I think, yeah, Worthing's been in lots of news articles recently for huge jumps in value over the last few years. So if you invested there a couple of years ago, fantastic. If you're looking to invest now, it's still on the up. So now's still a good time, but maybe
yeah.
really get into
Don't tell everybody, Adam.
that. Well, that's what value puts your value up, though. The more people that are buying there. So if you've already invested, I'm
True,
I say,
true.
yeah, but yeah.
And it's a lovely town, eh? It's a lovely town. Um, now budget.
Mm.
I know you've got. I'm hoping you've got a crystal ball there.
Yeah.
Um,
Yeah.
everyone's waiting to see what the Chancellor's got up her sleeve, Adam.
Mm.
What would you like to see in the budget for landlords and for the widening housing market?
I can tell you what I'd like to see. It's never going to happen. But what I would have liked to have seen is massive cuts or removal of stamp duty, um, reductions in capital gains tax, so it's easier to both buy and to sell, to move assets around. In my opinion, that's the best way to stimulate value growth, and also help people purchase. Figures will go up or values will go up. However, people aren't as limited in buying if there's less tax, right? Um,
Yeah,
not going to happen, unfortunately. More likely to go the other way. I don't think there will be increases on either capital gains or stamp duty this time around, but obviously, I also wouldn't be hugely surprised if they did one or the other.
yeah,
It does feel a great irony, I think, that tax on landlords as a whole has increased a lot in recent years. Um, the one low hanging fruit they don't seem to be increasing is capital gains. And I think that kind of makes sense. Yeah, it kind of plays into the anti-landlord rhetoric, though, right? Your
yeah,
tax faced as an existing landlord is increased, but they don't make it more difficult for you to leave the market, because the capital gains increased, it's more of an obstacle to than exit. So unfortunately, I think that does help the suggestion that they're trying to push private landlords out of the market potentially. Um,
indeed.
Quite why and whether that's the right move or not, we could debate for quite a long time, and I don't think we'd ever get the answers we want. But yeah, CGT and stamp duty would be things I would like to see change, but I don't think it's going to happen. Uh, Obviously, the bigger concerns is about increased tax, and there's been a lot of suggestions of increased tax and new taxes on rental income, in the form of VAT or national insurances and things, and how that income is then qualified for tax purposes. Um, it's sounding almost like a certainty, but we've been wrong in the past, so we'll hope we'll be wrong again.
Yeah, and I'm going to ask you a optimistic question.
Mm.
So, do you think that we'll get any meaningful tax reliefs or incentives, or is it going to be more stick, less carrot? And are
Yeah,
we in for a damn good thrashing, basically?
certainly more stick than carrot. I think the best people to be in property for this budget will be house builders and developers. It's a well understood point now that the UK is short of housing. Um, Consecutive governments haven't found a way to stimulate building. They've
Yeah,
tried, but it's not happened. And I think they'll try again. I think being a developer or a house builder, I think that's where the tax breaks will be, because the
yeah.
government will want to provide more housing. So I think they'll stimulate. That's where the potential savings will be. But for existing landlords, existing properties, I think you're more likely to be hurt than you are to be helped.
Yeah, and just going back slightly, and sorry to go slightly off piece, but are you seeing much worry from landlords with properties in their own name as opposed to old school? I
Yeah,
mean,
that's
we're old school as well to some extent, and we're thinking we've still got some property in our own name.
mm.
Is
Yeah,
that going
that's
to be an
been
issue?
a point for years. I mean, Section 24 was, of course, the biggest change there. That was the real turning point, I think, and I certainly noticed it from that point onwards. A lot of investors, even if you were only buying a single property, would start to buy in a company name for that exact reason. And I think it is becoming, more popular. I'd now say the majority of investors we work with buy in a limited company or some kind of special purpose vehicle. Um, Trouble is, of course, now a lot of investors we also work with look to make that change retrospectively. Maybe they are in your personal name and you try and put it in a company. There are ways to do that. I always have to preface that I'm not a tax consultant. There are ways to do that, but very few which do not involve paying capital gains tax. So though you might save
Mm,
your constant tax on income, you'll actually have to pay a lump sum to put it in the company in the first place, unless you've got a very good tax advisor. And there are ways to transfer that without facing that sort of initial setup cost in effect.
yeah. Um, so for us lovely landlords who want to stay in this crazy game,
Mm.
what's the one piece of advice that you'd give us all to stay profitable and compliant within the next 12 months, please, Adam?
I think manage your expectations, which
Yeah.
when you usually hear that in most walks of life, it's not really reassuring. But just manage your expectations. I think the next couple of years will be tough. Um, But the good thing about any market, but very true with property, is if you come through the tough periods, you're generally the better for it, right? If you can live within your means and you can keep a property, you might not earn the same gross return as you used to versus your increased costs. But as long as it's still paying the bills, it's not a burden to you. It's still worth holding tight because, as I mentioned earlier, for HMOs, for instance, people are selling HMOs. That pot gets smaller. The supply is down to reach the new levels of demand. And what will happen in several years' time is those points will meet again or perhaps cross over. And then I can see it already. We'll eventually find ourselves in a position that we have been for so many years in the past of a mass undersupply of HMOs and housing. And again, I mentioned it earlier, but underpinning everything to do with property is the fact we are short of property in the UK. So investing in property and being a landlord is always a needed thing, and it's always a safe investment in that respect. As long as you've got a plan, you know what that property's options are. You've got backup plans as well. If your primary market fails you, what are you going to do with that asset if it doesn't go as planned?
Yeah. Could you sum up the Brighton property market in one word for me, please?
Fun.
I love that.
It's good fun. It is. I'm going to elaborate on my one word there, but it keeps you on your toes. I think it's a fantastic market because, as you said earlier, we are in a bit of a bubble here. Especially, me at Coapt, we work with student properties, and we've got, even the housing. I said earlier I'm a nerd, but lovely Regency buildings. Some of the architecture and the property itself is the same down Worthing Way as well, to an extent, not quite as nice as Brighton, I don't think.
So naughty.
We've got some lovely housing and lovely, exciting investments. And I've always liked property as well because you get to meet fantastic people, fantastic tenants, fantastic landlords. Even, dare I say it, brokers and solicitors can be a good laugh sometimes as well.
Yeah.
And in Brighton, everybody knows Brighton for its quirkiness. And I think that translates to the property industry here as well.
Yeah, I'm with you 100%. I love my lovely town here in Worthing. I love Brighton, and I think we're all good people, eh? It's got this great vibes, and it's a special part of the world. Adam, thank you for your amazing words of wisdom today. And I'd just like to say as well, me and Nick, we've been with Coapt. You've managed one of our HMOs for us since 2008.
Wow.
Pre your time.
Yeah.
And me and Nick have been around in property for ages, and we trust you guys, and you're always just fantastic to deal with. And if people want to reach out to you, because we'll have lots of property people watching this hopefully, and who we talk to, how do they get in touch with you or Coapt? What's the plan?
Yeah, great question. And thanks, by the way, Tabs, as well. It's been a pleasure working with you on the property as well. So it's nice to hear you're
Pleasure.
enjoying it. But
Thank
yeah,
you.
we offer services for property management, property rental, property sales. We do then have third-party services as well for lending and financing, tax, insurance, everything you can think of. If we can't help, we've got someone who can. And as
Great.
I've also hopefully shown on this this lovely podcast as well, we just love a chat. So if you've got any property related questions about legislation, do reach out. Quite simple. You can reach our lettings team on lettings@coapt.co.uk or our sales team at sales@coapt.co.uk, or either of us on 01273 645 797.
Wonderful. Adam, thank you so much.
Thank you.
Can we get you on again sometime?
Please, anytime.
Wonderful. Go and enjoy the sunshine. It's glorious out there. And thank you so, so much. Much love to Coapt.
Cheers.
Thanks, Adam. Bye. You're so good.
Nice. Thank you.
You're brilliant. Thank you so much. Forgive me and my dreadful headphones.